Siddharth Vora is now joining us. He's head of quant investment strategy and fund manager at PL Asset Management. Siddharth, good afternoon. Good to have you with us here. Thanks for your time. Prashant this side. Today, momentum stocks are taking a bit of a break. I mean, actually, they're taking a pretty large break if you look at it. Check out the Nifty Alpha Index, which is basically comprised of these names. That index is down 2.5%. Right, your Trend and your CG Power and so many other names, which are down as we speak, and the Nifty is up. So the underperformance is almost 3.5%. I don't think it's happened in a long time. Are we in? And you throw in the defense names as well, HAL and BEL and what have you. Are we in for a slightly sharper pullback in some of these very high momentum names? What's your sense?
So over the last 1 month, actually, we made a very, very drastic change in our portfolios. So we launched our fund in June 2023, and for almost 1 year, we continued to hold a momentum and value tilt in the portfolio. But over the last 1 month, we actually moved out of a momentum value tilt and moved into a quality and low vol tilt in our portfolio. So our fund is actually known to switch its investment style based on the market regime. So it's style adaptive in nature. So I think that rebalance has really, started working in our favor. And I do believe that there is a very, very sharp case for mean reversion as well. So what we are looking at right now is that if you look at the quality factor and you look at its comparison or like a discount from a quality to a value, there is a lifetime high discount between the quality and value factor. So we definitely think that data suggests a strong mean reversion case. Even if I'm looking at my other valuation, breadth, sentiment, and volatility indicators, most of them are at cyclical peaks and troughs, which again suggest a case of mean reversion. So to deal with all of this, what we have done in our portfolio is created a very tactical defense layer in terms of diversifying the portfolio from our standard 25 stock portfolio to a 50 stock portfolio for the first time. The other thing which we've done is created a 30% exposure to defensive sectors such as consumer, healthcare, and a bit of IT as well. So for the last 1 year, we were mainly dominated by cyclicals. We've now finally started adding non-cyclicals as well to the portfolio.
Siddharth, afternoon, Reema here. So how long does this tactical shift, play out? So for instance, how quickly before, this mean reversion takes place? Is this a 2 month, 3 month? Because you've got to be very agile, and not all retail shareholders will be. So put your strategy into context with some timelines. So, or in terms of some levels, or go ahead.
Sure. So we follow a 2 monthly rebalance cycle in our portfolio. So every 2 months, we review all the market models, the risk models, the macro models, style models, and sectoral regime models to decide how the portfolio must be tweaked across any of these dimensions. And the last rebalance was the 5th time in the last 18 years where we got a switch into a dual portfolio. So rather than following a single style or a single regime, which was value momentum, we've now divided 50% of the portfolio to value momentum and the other 50 to a quality low vol. And I think this is quite a rare occurrence to happen. As I said, 5 times in the last 18 years. So every 2 months we rebalance. And at the end of 2 months, if this continues, we continue holding the same strategy. If the data suggests that we need to realign again, we will rebalance and tweak some aspects of the portfolio once again.
Siddharth, and this you're describing, at the PMS, all strategies are quant strategies, or is what you're describing primarily for one of the quant strategies?
So as a group, we pivoted out of active money management and into a pure play quant asset manager close to 2 years back. So now we're running 3 strategies. All of them are 100% pure quant driven.
Okay, got it. Just wanted that clarity for our viewers. Now, with what you described, and these terms, these days, the definitions also change so much. A year back, what was value is now momentum / growth. And, these terms are, it's not cast in stone anymore, and it could change in a matter of months. So therefore, now I'm going to talk sectors, right? So let's say if you've got something like, capex, defense, capital goods, this whole basket which has been just zooming ahead, and many of them are PSU stocks as well. What do you call them now? Is that momentum for you, erstwhile value, etc.? And basically, what is the positioning on them?
So I'll give you your take on quality and value. It's very interesting, and actually we've been seeing this and communicating it to our investors as well. So the erstwhile value factor is no more value. The actual value is in the quality factor. As I said, the discount between quality and value as a factor is at cyclical highs, which means quality has never been cheaper as a basket and value has never been more expensive as a basket. So there is actual value in the quality factor. Having said that, we've reduced our exposure to industrials, cap goods, defense, that whole pack, from a 38% exposure, say 1 month back, to a 26%. So we've cut that exposure by 12%, and that's moved to healthcare now. So we've created a layer of defense in the portfolio. As I'm saying, we do perceive some sort of mean reversion in the markets as well. So 12 months, we perceived the markets to be in a risk on mode. Now we are perceiving the markets to be in a risk transition mode.
Hi, Sid. Good afternoon. Good to see you in. So you're moving some money out of industrials to healthcare. You want to categorize healthcare because that's a very, very large segment out there. How are you all playing it?
No diagnostics and hospitals. It's just the pharma names.
Oh, just the pharma names. All right.
Yes.
Well, what about, if you could give us a sense on the banking names, how are you all positioned out there? Because there's been that raging debate over there on banks that, yes, there is valuation comfort, but there's a split verdict, whether the PSUs have more fuel in the system. How are you all positioned over there?
So right now, we don't own any private banks in the portfolio, and as of now, not even PSU banks. In the last 12 months, we've had a healthy around 22% odd financial exposure. But in the last 12 months, we've not even owned a single private bank. So we've created significant alpha from our financial exposure, but we've mainly owned PSU banks, PSU NBFCs, and all the capital market plays. So just to give you a few names that we've owned in the past, no more own them. It's been BSE, PFC, REC, Nippon India Asset Management, HDFC AMC, Motilal Oswal. These have been some of the names that we've owned in our portfolio. We've already exited them, I would say, 2-3 months back. So we no more own them. But this is how we've played our financial exposure through a set of diversified financials, I would like to call them, rather than the traditional private banks.
Siddharth, in terms of your published portfolio, can you just give us a flavor of the sort of top five or six holdings right now?
So the good thing, or the more differentiated aspect of our portfolio, is that we run an equal weighted portfolio. So there is nothing like top five. I could just tell you my top 5 performers rather than my top 5 holdings, right? And in terms of our sectoral mix, we have autos at around 28% of the portfolio, which covers the ancillary pack and the automobile OEMs. We have industrials at close to 26% is industrials, healthcare at 12%, consumer at another 16%, and IT at 4%. That's the broad breakup of the top 5 sectors that we're owning right now. I forgot real estate. Real estate is at 7.5% as well.
And which are each? What's the name each from each of these sectors, Siddharth?
So I'll tell you some of the big winners in the industrial pack have been Cochin Shipyard, Mazgaon Dock, GRSE, GE Shipping, HAL. These have been some big names. From the auto pack, we've had Bajaj Auto, Hero Moto, M&M, Maruti. These have been some of the big names that we've been owning. In real estate, we have Oberoi, Lodha, NBCC, and in MRF also in the auto pack.
Sure. In that defense, industrials, largely defense name, not defense, I mean shipbuilders, etc. What are you doing with those now, Siddharth?
So as I said, we were owning 4% to each of them 1 month back. We've now pruned the allocations, booked significant profits, and the allocations are now down to roughly 2% each. So we booked significant profits in all these stocks, which we've been holding for a good 6-8 months in our portfolio.
So, Siddharth, just to conclude, and again, I'm going back to slightly more academic question. For a lot of quant strategies, momentum is a very important factor. And as long as you have a trending market up or down, I mean, quant strategies work pretty okay, right? Correct me if I'm wrong. But as a house, what's the call that you're now taking? Are you expecting this to get into a bit of a ranging market? Because you mentioned, and that's therefore the changing positions that you're taking.
Right.
And, as a overall strategy, is it value, quality, momentum? What's the overarching theme that defines the three of the strategies that you discussed today?
Sure. So, firstly, momentum is usually an important factor for quant strategies. But in the fund that we're talking about today, or the strategy we're talking about today, which is Aqua, it's actually a style agnostic and style adaptive strategy, which means momentum is just one of the factors we look at, with not more than 20% weightage in stock selection. But based on the cycle we're in, the weights of the different factors changes. For example, right now, quality and low vol are the most dominating factors in our portfolio, followed by value and then momentum. So till December, momentum was the dominating factor. Post-December, value and momentum became dominating factors. And now quality, low vol are becoming dominating factors. So we are not focused only on momentum to drive returns. Sometimes we focus on alpha generation on the upside. Sometimes we focus on risk-adjusted returns like we're doing now. In
Fair
terms
enough.
of style orientation, as I said, first time in the last 1 year and fifth time in the last 18 years, there is a regime split, which means what our models are trying to tell us is they neither have conviction that value momentum regime will continue like it did for the last roughly 2.5 years, neither do they believe fully that quality is now the dominating regime, which is why they've given us a model portfolio which splits equally across both of them. So 25
Got it.
stocks from the quality low vol pack, 25 stocks from the value momentum pack, all given an equal 2% weight. So it's a 50.
Got it. So your models are telling you that we are at crossroads in this market. Interesting. We are going to remember that and look forward to discussing this in the future as well. Thank you for joining in today. Well, that's a view from Prabhudas Leeladhar from the PMS strategies that they are adopting. We will take a break on